Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with stocks inching lower. Jim Zelter and the team over at Apollo Asset Management looking for opportunity outside of equities, saying, quote, if interest rates remain higher, as we expect, and the terminal Fed funds rate stays higher than where it has been historically, we see private credit as an attractive alternative to overvalued public equities. Jim joins us now for more. Jim, good morning and a very happy new year to you.
Good morning, Jonathan.
I'm going to kick off this conversation by stealing one of Lisa's questions to start 2025. Are stocks too rich or are bonds too cheap?
Well, I think we have a backdrop. I think your point about the U.S. and China and Europe and the three parties, it's our view that and Torsten has been very consistent. The U.S. economy has been the beacon of opportunity in the last several years. Strong economic growth, capital coming in from around the globe. And so in terms of, I don't want to talk about the stock market, I'd rather talk about the underlying economy.
Sure.
Underlying economy looks like it's the place to invest. I don't think it's any surprise that when you peel the onion back, private capital, which has really been embraced in the U.S. and gives diversity of funding, lets companies grow, start, expand, and all the things we're talking about, the global renaissance, it's been the place to invest and it's been attracting capital. Contrast that to what's going on in the UK and continental Europe, where they are stuck in a financing system that's really 15, 20, 30 years behind the rest of what's going on in North America. It tells us that the U.S. is the place to invest.
So you think some of these problems in Europe might be more structural in nature? I
think structural is really the key to really analysis. It's very easy to focus on the last 3 to 6 months. We talk about the Liz Truss moment in the UK. I think it is a great reminder for this current administration as they've got great ambitions in terms of U.S. investment, CapEx, tariffs, immigration, a variety of other big initiatives. It's good for this reminder of the Liz Truss moment in the back of their minds to know what can happen if you lose confidence. But there's no doubt, I think, if you look at what the Draghi document did, later last fall, he pointed out in 158 summary pages of all the challenges that they have not really embraced. And while the banks are in better shape than they've been in a couple of decades in Europe, the U.S. is the standout. We have the greatest financial services sector in the world. We have the deepest, broadest capital markets. We've undergone a tremendous amount of regulations on our banks, and they've continued to thrive in a more narrow world. And that's the page that the Europeans should be looking at, embracing securitization, embracing private capital. They've got a massive amount of infrastructure needs, and they should be embracing that for their long-term economic success.
In the meantime, people are saying that maybe the ghost of Liz Truss is kind of hovering over this administration and hovering over the U.S. Treasury market right now, especially given the rise that we've seen in longer-term yields. And I'm wondering how susceptible you are to changing your view on how constructive the U.S. economy is if you get some more negative data prints. We had Greg Dako yesterday talking about a frozen job market. We had Nela Richardson talking about how smaller companies really are feeling rates where they are.
Rates have been higher for the last 12 to 18 months. They've been higher. Obviously, we're in a period right now where what the Fed did in its actions in the fall and what the market has responded to is a very unique period. So you're right. We are in a little bit of a unique zone here with regard to macro and rates in the U.S. I do think we are in a period where rates do look attractive versus where equities are. And we're in a period right now where we're still the place of economic growth, but it is a warning warning sign for the administration about how much they can push. Now, clearly, the other side of the trade, I would not probably be lowering rates right now. I think that you have full employment, economy's doing quite well. I'm not sure I see a need other than economic textbook to lower rates in terms of the target, but it does create a lot of room for the new administration if they have weakness in any kind of the economy because of their initiatives. The Fed put us back, they have a lot of room to move.
Your colleague is sort of edifying your points as you say them, Torsten Slok, moments ago. Inflation reaccelerating, to your point about not necessarily needing to lower rates further. You talk about credit being the sweet spot and debt, maybe even over equities, and that has been the story over a long period of time, this past couple of years. If inflation could be reaccelerating, could you see that story changing at a certain point?
Yes, you could, and I guess listen, there's a lot of consensus out there about where the S&P is going to go, where rates are going, but in our view, in the backdrop, the U.S. economy is still the strength of the globe. It's the beacon of economic opportunity. We still have a lot of economic growth in terms of the industrial renaissance that we've been talking about. So, in our view, the breadth of credit, investment grade as well as non-investment grade, we try to find areas of dislocation or areas of mismatch of capital and opportunity, and we're still seeing it in credit versus the equity markets. Now, when you look at the S&P 500, I would say that it's interesting. We all know what the Magnificent Seven are, but certainly the other 493, a lot of unloved opportunities in that basket, and there's probably an opportunity in a non-consensus view in terms of those companies in terms of just pure economic growth. But we are still, listen, private credit and private capital has been the engine of economic growth in the U.S. And I will, again, I said earlier, it's not a great irony. It's a great irony that the U.S. has been the bastion of economic growth with the embracing of private capital. But, one of the greatest investors in U.S. capital history, Warren Buffett and Berkshire. When you really pull the covers back on Berkshire Hathaway, of the $1 trillion of assets at the end of 23, 30% are in the public equities that we know about. Apple, Coca-Cola, American Express, B of A. But 70% are private companies. It's the growth engine. He's the greatest capitalist. He's been doing it for 50 years. That's where growth and opportunity is in America. Private capital in private companies. And they have access in the debt markets. They don't need to go public to raise capital anymore. 8,000 public companies to 4,000. That's the trend in the future. And we're sitting really at an intersection trying to bring those opportunities to the broad group of investors, retirees, and savers around the globe.
So you mentioned Europe, and Europe, certainly, the bank channel is overburdened. We've been talking about this for years, the Europeans have. Draghi talked about trying to do something with public markets in the same way we have here in the United States. It's not happening. I want to understand from your perspective how you will work with the banks in America going forward from here, because this is kind of a new trend where the banks will originate the loans and then you'll provide the money. How's that going to work in years to come? How big can that opportunity be?
Oh, I think 24 was a pivot year. For us as a leading firm in this industry and in this sector, there was a great headline, and you and I talked about, the three of us have talked about on this show many times, where the great battle between private capital and banks. The reality is, if you look at the commercial dialogue going on between the top 5, top 10 institutions and the handful of us that lead our industry, the amount of integration, dialogue, working together on big deals has never been deeper. Obviously, there was our Citigroup transaction, there was the transaction we did with Standard Chartered, BNP, and so I think we're still at the early days. These partnerships need to have substance. They can't be, excuse the phrase, shotgun marriages. They have to be ones that really have substance, dialogue, trust, and some history of doing a lot of transactions together. We've been fortunate in all the ones we've put together where there has been a lot of either history of personnel or of activity. But I think still it's early days, early innings. Now, there's a lot of headlines just to grab headlines, and there's not a lot of substance behind them. But I think that trend of private capital and bank partnerships is going to extend in 25 and 26. And I do think, if you think about the economic backdrop, I do sense that there is a great opportunity for strategic M&A. That clearly feels like it's going to happen. I'm a little bit more skeptical about the massive IPO window. If you look at the last 10 years, Equity issuance has been about 250 billion, 50 billion IPOs, 200 billion secondaries. That's removing all the SPAC numbers. I think you still have a valuation issue with a lot of private equity companies that want to come out and do their IPO. And so I think we have a consensus view or non-consensus view at Apollo that number is going to be not as large as people think. And so the big mismatch, if you have a big credit market, a big equity market, this area of hybrid in between, which we've been talking a lot about, applying capital to those over-levered companies, that's the opportunity of 25 and 26.
Just to build on the IPO issue just a little bit more, is that just a valuation issue, or do you think it's a role that you have to play here, that these companies don't need to go public anymore?
It's a combination of both. It's a great question. I think it is a valuation issue for probably 50 to 60% of them. I think it's very, very clear now private companies have access to all sorts of capital, debt and equity, preferred, convertible, whatever it may be. And so the typical route where you needed to go to have your employees be able to monetize their investments, broad-based capital, equity, revolvers. You saw what OpenAI did several months ago, bringing in a bank facility. There's tremendous pools of capital, private capital, that can fund and finance these companies. So going public is by no means the ticket to liquidity that you needed in the past. A lot more options.
In 5 to 10 years, will there be a difference between public and private markets?
We don't believe so. I think there will be some differentiations, and I think the question that gets raised right after that question that you ask is, well, is there going to be a massive compression in yields? And the advantage is going to go to those folks that have the bigger, you're going to make money on the origination. The ability to make the $3, $5, $7, $10 billion commitment to XYZ company, that's where you're going to garner the extra spread. But all the things that we're doing in origination, in capital formation, in trying to bring some liquidity to these markets in terms of secondary activity with transparency and price discovery, I think the barriers and what's private is risky and what's public is safe, I think those barriers will be coming down. And again, I go back to this Berkshire. No one really talks about it, but it is quite an irony that the greatest public investor of all time, 70% of those companies, when you look at the web page, these are some great American companies. And over 50 years, he's assembled them, and they're massive compounders. And that's 70% of the underlying value. Geico being at the top, Clayton Homes, BNSF, many, many other great companies. And I think that's a lesson for us all. There's companies that are private and there's private equity. You should differentiate between the two, but we clearly want to be part of that big trend and offer those to investors and retirees around the globe. It's a big change in market structure.
You're going to be sticking with us to talk about that change in market structure and the changes we could be seeing in Washington, D.C. a little bit later this year. Jim Zelter there of Apollo Asset Management. Nela Richardson of ADP predicting a slowdown, writing the labour market downshifted to a more modest pace of growth in the final month of 24, with a slowdown in both hiring and pay gains. I'm pleased to say that Nela joins us now for more. Nela, good to see you. Happy New Year.
Happy New Year. Good to see you.
You put out your numbers yesterday.
That's right.
Where did you see weakness and where did you see some strength?
Well, we saw weakness in manufacturing, and this is, doubling down on a trend we've been seeing all year. 3 consecutive months of shedding jobs in manufacturing. That's very cyclical. On the strength side, we have to turn to a very non-cyclical sector, which is healthcare. Healthcare has been posting strong gains for the last 6 months. You see that in the ADP data. You also see that in the BLS data. It's what's really driving the jobs market now. And the question is it enough for 2025 for healthcare to be in the dominant position?
Are workers losing leverage against that backdrop? If you're seeing more narrow gains, if we're losing breadth and it's coming from areas outside of cyclical sectors in the economy, are we seeing a loss of leverage for workers more broadly? We've been talking about this over the past few days. JP Morgan saying, get back to work, get back to the office 5 days a week. We talked about it a little bit earlier this morning, that maybe that's why the unions on the docks are maybe settling a little bit earlier. What are you seeing around pay and signs of a loss of leverage?
We're seeing a lot, and I would align with those remarks that workers have lost some leverage from the heyday of the Great Resignation when they were clearly in the driver's seat. There is no one in the driver's seat right now. I think in the labor market it's pretty calm and quiet. But what we're seeing is that pay growth has declined. We're looking at the lowest pay growth for job stayers since 2021. So that is significant. But also you have to look at hours worked, and that's where companies are kind of fine-tuning their labor count. Layoffs are very low. They're at historical lows for the past 2 years, but the number of hours people are working have been declining consistently over the past year and a half. That means that workers are making less. Also, I'll point to the JOLTS data that came out this week. Everyone made a big hubbub about the job openings. I went directly to the job quits, which are much lower. So people are staying put in their jobs, and that means there's been very little turnover in this labor market.
I agree with you. 1.9%, which is tied with the lowest rate for quits going back to 2020, and really raises some eyebrows about just how much mobility an agency workers feel. I am wondering the why behind this. Is it because of policy uncertainty from companies? Is it because borrowing costs are higher and they're not making big expansionary moves? Or is it because they're still watching what's going on the artificial intelligence front with the potential that this will make some big changes to their workforce and they're not sure exactly how?
So let's take those pieces together. I think there is a bit of uncertainty about policies, but when you look at where the weakness is in terms of firm size, it's really been in small firms that we've seen the slowdown in hiring. Big firms are still hiring, and you see that clearly in the ADP data. So that points to more financing constraints than it does to AI investment or uncertainty about what, the next tariff policy will be. Most small firms don't operate in that macro scenario on a consistent basis when adding 1 or 2 employees. So when you're looking at that, interest rates matter in terms of financing costs for small firms. Longer term, over 2025, I think that AI investment and those trade-offs between capital and labor become much more relevant starting this year, but also into the future.
Are you saying that on the ground, from the bottom up, what you're seeing is that long and variable lags still do exist, and that they just got a lot longer, and that they still are restricting certain smaller companies?
They've gotten a lot more variable. Our lags.
Okay. All right. So they've gotten a lot more variable, and that's the reason why you are seeing it only in smaller businesses. But are you saying that rates staying here might look like they're not necessarily hampering financial conditions, but they are constraining the labor market in a more significant degree at this point than they did even 6 months ago?
Firms that rely on bank capital and small business loans are feeling the effects of higher interest rates. It may not be translating to the larger firms yet, but in terms of on the ground, the mom and pop, the Main Street businesses, I think you see that in their hiring decisions. And so yes, that is material because small firms are the engine of growth for the labor market and for the economy. And if you want that dynamism to continue, it really has to be at the small firm level.
So Nela, what's your reaction to the recent shift over at the Federal Reserve? What do you make of things?
There's been a couple shifts. I think what we're seeing in terms of the commentary around the Fed is that they have put out this idea of being more patient. And this is a Fed that we're not really used to seeing historically. Usually the Fed, when it's starting a policy change, it's moderate, predictable, modest moves every decision meeting. Now we're seeing a Fed that says, hey, we might take a break. We might, go on vacation for this one and do a rate cut at the next meeting. And I think that adds a little uncertainty to what the future path of interest rates will be.
And some of us might include some changes to policy that we might expect, and some of us might not. And that's been part of the confusion as well, Lisa, over the past month or so. How
does a market factor in what the Fed is going to be looking at when we don't have a sense of what policies and input data will potentially be going into their equation? It makes it rather confusing.
Does that make it more confusing for you, Nela?
For me, it's about the data, right? Some of this is just kind of animal spirits. It matters for the markets. It matters for the mood of making investment decisions. But does it matter for that HR director in a company who's trying to figure out how to grow a business in a particular area? Those policy changes are not going to hit that HR director in this month. It might play out over 6 months or a year, but they have to figure out the here and now in terms of the economic conditions that they're confronting with their customers, not what the Fed is doing.
It's increasingly complex, that's for sure. Nela, it's good to see you, as always. Thanks for dropping by. Nela Richardson there of ADP. Let's head down to Washington, D.C., where Anne-Marie is sitting down with the former senior U.S. intelligence official, Norman Roule. Hi, Anne-Marie.
Hey, John, thanks so much. Yeah, what we're hearing right now from the incoming Trump administration, from Steve Witkoff, who went over to Doha to be a part and witness these negotiations and to really lend some support, is that they think that they can have good news to deliver. So, of course, we want to bring in Norm Roule, who spent decades at the CIA dealing with Middle East and conflicts. Norm, is it your understanding that potentially we could get a Gaza hostage agreement before President Biden leaves office?
Good morning. Yes, that is correct. The incoming Trump administration and outgoing Biden administration have been working very closely with no reports of any disagreements or frictions to achieve this. The statements by President Trump beginning in December that there would be all hell to pay if the hostages were not released injected new life into this issue. And both Hamas and the Israelis have claimed that they have made concessions to make this hostage deal, which would be the first phase of a longer deal, happen. This said, the phrase cautious optimism has been used repeatedly in the past. Hamas has not dropped its primary demand, which is that Israel end the war and withdraw. Israel has not dropped its primary demand, which is Hamas cannot be allowed to regain control over Gaza. So the exit strategy for this conflict continues to be tied to this hostage deal.
Norm, I'm in Washington, D.C. today because of the funeral of President Jimmy Carter. And like Jimmy Carter, President Biden, on his final days of office, is working to secure Americans abroad. Now, obviously, these hostages, I'm talking about the Iranian hostage crisis that Carter dealt with. The conflict, the crisis, very different in nature. But all roads lead back to Iran. Given your work and decades of experience dealing with Iran, what has changed from Jimmy Carter's presidency to now?
In some ways, the modus operandi of Iran and its proxies and hostage-taking remains identical. And in fact, there's another echo from 1979. During the Carter administration, the Algerians played a prominent role in engaging with the Iranians. Today, we have the Qatari government playing its large role in dealing with Hamas itself and sometimes the Iranians. So you do have strange echoes of this period. But since 1979, not only the Carter administration, but the Reagan administration in Lebanon and the United States repeatedly with Iran have dealt with a drumbeat of hostage-taking by Iran and its proxies. And these events tend to be multi-month, multi-year in many cases, where in the end, significant financial or political concessions are required to release hostages. Iran and its proxies have very little care for human life and dignity, but focus on their own interests.
Many observers would point to the peace agreement between Egypt and Israel that Carter was able to get over the finish line. How do you see that shaping the region?
It was dramatic and significant, but at the time it was not something that was a sure thing. The Carter administration entered office hoping to follow the steps of its predecessors, large international conferences involving the Soviet Union, the Geneva process. In fact, the Carter administration was not initially enthusiastic about Sadat's solo diplomatic engagement. The Washington Post at the time famously described the cool Carter reception as being so chilly it could freeze the Nile. But it did open for the first time the possibility of something that eventually under the Trump administration became the Abraham Accords. It's just things move slowly on these issues.
I'd love to end on that point because we do have an outgoing president who wanted to expand peace in the region, that Abraham Accords between Saudi Arabia and Israel. He wasn't able to finish it. And now we have an incoming Trump administration that certainly wants to make sure they're able to get that over the finish line. Do you see that doable in the next 4 years?
Yes. And in fact, the Biden administration also built on the previous Trump administration's work to pull together a Gulf security agreement with an important agreement with the government of Bahrain. And this agreement with Bahrain, which is a bilateral security agreement with the United States, now also includes the United Kingdom and is open to other partners. I think what we're going to see is perhaps not an expansion of the Abraham Accords, although that is possible. We may see economic integration. We may see greater an expansion of the Bahrain agreement. We may see a variety of different architectures, but if a two-state process can be established, I think it's inevitable that you're going to see this integration of the region, which would mean an expansion of the Abraham Accords and the peace process.
Norm, thank you so much. Jonathan, that was, of course, Norman Roule, a former U.S. intelligence official.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.